People and investors are underestimating what could happen here in 2023. We are only days away, and yet people are acting so aloof. That is a very big mistake. The first thing I need to talk about is where the biggest risk is. If you are in these sectors, it is time to watch out. The second thing I want to look at is stocks and the investors' response to that. I will bring all of these together. Let's begin. Roughly 1 in 3 workers is worried about a layoff. Here's where the anxiety is the highest. So in this article out of CNBC, it basically talks about the fact that 31% of people are saying that they're concerned their company is planning budget cuts or layoffs. We see this all the time. As soon as there's the potential for a recession, as soon as there's a hike in interest rates, companies start to say we have to let some people go. And of course, the way this generally works is the first round of layoffs are the poor performers. Let's get rid of those people. They weren't really doing their job. The next round is when it starts to get more difficult. Usually they go for the people who have been in that position. Maybe they have that seniority. Maybe they are a faithful employee, but they've been there for too long and therefore making too much money. So they get that person out and they bring somebody else in. This happens time and time again. It's cost reduction, or what they call increased productivity. That's what you are to them. Simply kicking the can to the curb, and they will unfortunately increase their productivity. Shareholders love it though. Okay, so they break it down where they are the least anxious. That's legal, administrative, military, community, and accounting. But then we look at where people are concerned. Product management, quality assurance, marketing, finance, and the one I really want to break down, information technology. 37% are concerned about budget cuts and or layoffs. A lot of recent tech layoffs making headlines are due to overhiring to build new products and services to meet the exploding demand through 2020. I would actually disagree with that, but we'll talk more about that in a second here. And then it just says they have these, the issues of when we look at central bank tightening, quantitative tightening, meaning they print less money and they raise interest rates. This is key, right? Because if you're not going to pay attention to that, you're going to miss out on one very big factor. And that's why I see a lot of people saying, is it now the time? Is later the time? When's the best time to get in? Should I dollar cost average because I simply can't pay attention? All of these things are really, look at the depth of it. You see what the Federal Reserve does. You hear the statement over and over again. And I think I have that chart or that article lined up in a second, but it's don't fight the Fed. Have you ever heard that? Don't fight the Fed? Well, that was fine and fantastic all the way up. But now some people say, well, you got to fight the Fed sometimes, or you're not going to have to fight them eventually. These things are roadblocks to you attaining your goals. If your goal is maximum appreciation, why are you following along with what the herd does? That doesn't make any sense. Now, does it? I want to break it down for you right here and now. Tech jobs are at risk of layoffs due to overhiring, automation, and poor stock performance. In the late 1990s, companies in the tech sector experienced a huge boom that led to overhiring and rapid expansion. This created an unsustainable bubble of inflated stock values and a large number of tech companies with too many employees relative to the demand for their services. When the bubble burst in 2000, many of these companies had to lay off significant numbers of employees in order to downsize and become profitable again. The increased automation of processes in the tech industry has led to further job losses as companies strive to reduce costs and become more efficient. This automation has been further exacerbated by the recent poor performance of tech stocks, which has led to increased pressure on companies to cut costs and remain profitable. That's what we see right now. That isn't even factoring in the obvious 800-pound gorilla in the room, which is AI. Now, AI is still in its infancy, but you can see every company seemingly getting in on this. We've got OpenAI with their Chat GPT being very popular right now. And there are so many other factors that are going into AI that will, in fact, displace jobs. Writing articles and anything where the data is kind of already there, where they can simply pull that in. It's going to be something very interesting to watch. So we will pay attention. Just watch where your skills are at. Understand that there are some things that are not likely to be automated in the near future. That's where you want to be. This article here is basically talking about increased expenditures. And that's kind of what I want to show you here. There's inflationary factors and there are deflationary factors. And that's going to determine the direction we take in 2023. Some believe that we see some level of deflation and therefore the Federal Reserve changes their tune. They start to pump up. We don't know. We'll see. And they basically talk about even trash collecting rates are going up. You look at the cost of doing business within a city is going up. That's just generally what they're suggesting here in this article. Okay, that's a primary factor because governments get so big and bloated, their budgets never decline. It's very important if you know anybody that works for the city and where you live or anywhere. Basically, they say that we can never have a budget that was less than or equal to the previous budget. It always has to be larger. And so they just get more bloated as time goes on. It doesn't necessarily mean you're going to get better services. It just means that they're going to spend more money. The era of cheap oil has come to an end. The recent crude price slump may not be indicative of what is to come in the oil markets, according to several investment bank analysts. And they're talking about the production. But I do believe, and by the way, they talk about not having enough investment in pulling more out of the ground. And why would that be the case? Well, if you look at the shale industry in the United States, they're looking at this very clearly and they're saying, where's the money in this? Where is the money right now? Because they're telling us they're going to shut us down. They want wind turbines. They want solar. They don't want oil and gas. And that's, regardless of what side you stand on. The government is basically saying, we don't want that stuff. So they're making it harder to do business. And so entrepreneurs, investment companies, they don't want to put capital into that. So you could see what's happening right now. So there are, like I said, inflationary factors. But then we have some deflationary factors. Atlantic spot rates about to collapse. So when you move stuff overseas on these big ships, it depends on the route, of course, but they track those prices. And during 2020, they made more money than ever before. Those rates are coming down. All of them seemingly are coming down right now at this time, showing us there's less stuff that needs to be moved. That should be a telltale sign, shouldn't it? And this is a little bit of humor. If you were on this channel in 2020, when we talked about transitory, you remember that transitory? Very, very funny stuff. But you can see here, recent US inflation data has been a win for Team Transitory, the economists who predicted that inflation would come down without interest rate hikes. I just thought it was really funny to even talk about Team Transitory. Haven't heard that in a long time. But anybody who was on this channel knew that that was not the case, that it would not be transitory. And here we are today. I think it's funny, to say the least. China hints at pro-business policies, smaller fiscal boost. Senior officials say increasing domestic demand is key in 2023. Economists see monetary policy remaining relatively loose. I've told you this hundreds of times now. Since 2020, things have really diverged in between China and the rest of the world. If you see what China's doing, they are stimulating massively right now, whereas the rest of the world is tightening. Now, the rest of the world's kind of going into a slower mode, no doubt, but if we compare that to China, it seems like a 180-degree difference. So we have to look at that, of course, you could see it on a global level and say generally things are tightening, but when we start to break that down, that's a different story. All right. And this is talking about the fact that Bloomberg, an economist at Bloomberg, believes that dark times could lie ahead. Now you see the potential for less and less growth, and you hear it right here. His analysis also shows that the US economy is entering a recession at the end of 2023. For the euro area, a recession is expected at the start of 2023. Very interesting, right? We will see if they actually do admit that. In the US, with wage gains set to keep inflation above target, we think that the Fed is headed towards a terminal rate of 5%. Terminal basically means that that's really going to stop hiking, 5%. Okay? And it will stay there until the first quarter of 2024. Many people have believed that it will actually happen earlier in 2023. I don't know. I can't predict the future, but I can certainly tell you that things are looking interesting, to say the least. Now, of course, you could follow me on Twitter, or you could follow me on TikTok and do some dancing over there. No, I'm kidding. But what I actually would like for you to do is, if you have a moment, hit that like button down below if you found this video informative so far. Let's talk about what's happening with the markets and investors. Really key stuff happening today, because you can see millionaire investors, I should say, haven't been this bearish since 2008. Very strange, because the market is not really down much at all. I mean, if you think about it, where is it? You've got the S&P around 3,800. Is that really down? Yeah, it did peak at, around 5,000, but it's not really down that much. But yet, they're claiming that they're the most bearish they've been since 2008. Millionaires plan to cut their holiday spending due to inflation. Millionaires, can you believe this? I don't know where their money is potentially tied up in that they don't want to pull that out to then spend. Maybe they bought cryptocurrency and they're saying, I'm going to wait this out because I believe it's going to go higher. Maybe they bought into Cathie Wood's ARK investment fund. Maybe they own Tesla. Who knows? We know that it's going to be the retail favorites. Retail investors love to get into those retail favorites. And so we'll see what happens. It's not inflation. I believe they have lost their gains and are now sitting on that because they believe it'll go higher. We'll see what happens as a result of all this. Very funny. I wanted to include this as well. Don't fight the Fed has never been more important than now. The Fed's message over the inflation fight seems not to be getting through to most people. And that's really what I wanted to break down, because if you see the patterns in the previous cycles, people should be aware of all this. And yet, look at what they do time and time and time again. This is the way it goes, right? How can they do this? How can they actually turn up interest rates without causing a problem? Oh, and then they did cause a problem. It's because of inflation. Many people haven't lived through any time where inflation went higher. So of course, they refuse to believe it. And yet, here we are. One of those stocks that is really taking a beating is Amazon. One of the biggest companies in the world. Like, how many times do you see those Amazon trucks driving around? You're constantly seeing people ordering billions of products listed, billions of data points all along that they have on customers and their products. Amazon stock gives up its last of its gains it experienced from 2020 after almost 50% slump in 2022. No matter how prevalent the company is and, within somebody's lives or, people in your area or what have you, the stock does not necessarily correlate. Understand that. I tried to explain that to everybody in 2020, and here we are. Okay? Very important. Actually, if you look at where it is today, it's at the same level it was in 2018. So it's incredible. Absolutely incredible. And I just wanted to show you that the biggest risk right now to tech stocks is potentially going to be pushed over the edge. Industry spending on advertising to fend off regulation for tech stocks has exceeded $100 million since the beginning of 2021. So essentially what they do, all these big companies, Meta and Apple and Amazon and everybody else, they lobby the government, don't regulate us. We want things to be fantastic. We want to grow. We want to hire people. We want to do this and that. Make sure your people in government do not regulate us. If you compare the regulation of the financial industry, which look at what happened during the financial crisis. Look at how they rolled back so much of that ever since. And yet the financial industry is like 100 times more regulated than the tech industry. If the tech industry gets regulated to some degree, more so than what it is now, which is very little, it's going to be very big trouble for a lot of these companies. Right now in the EU, they got, Meta, I think, with the antitrust. They're doing that for so many companies. Nothing usually happens. They get a fine. But if we go into more of this, a tighter response from the government, I think it is bearish overall for these tech companies. We'll see what happens. If you found this video informative, hit that subscribe button. Tomorrow, I'm going to bring you some really good information. You don't want to miss it. Hit subscribe. See you then. Bye.